FunSupermart.com.
We favor global emerging markets given their attractive valuations and higher potential upside as compared to their developed counterparts. Does Franklin Templeton share the same view?
Absolutely, yes. So within the Templeton Emerging Markets Group, we think the outlook in emerging markets is very favorable currently. If you look, first of all, at valuations, you can see that developed markets trade at a roughly 50% premium relative to emerging markets on a price-earnings basis. It's also similar on a host of other metrics, including price book, price sales, and so on. And so the question is, what does that premium in developed markets buy you? Well, it's certainly not buying you growth. From a macro perspective, developed markets are growing at roughly half the speed of emerging markets. And similarly, company level, you see growth is much higher in emerging markets also, with superior earnings per share growth going forwards. And so the question is, why do you have this big discount for emerging markets? And a large part of that is driven by fear. And in turn, that comes to one of the crux issues at the moment, is that you have a growing bifurcation in emerging markets in terms of performance, in terms of policy, in terms of reform. So whilst the likes of Russia is hogging the headlines with its pseudo-invasion of Ukraine, on the other hand, you're seeing, particularly within Asia, some very positive developments in terms of reform, with pro-business leaders in Indonesia, India, increasingly reform aspects taking place in China especially as well. And so, in fact, going forwards, an even more favourable growth outlook, which we think will be very beneficial for bottom-up, active investors in particular.
What key investment themes do you favour at the moment?
So first of all, it's important for us to emphasise that we're bottom-up stock pickers. So what is driving our investments is not a top-down view on a country or a sector, but rather our bottom-up forecasts of growth for each individual company which we research. But with that in mind, of course, there are certainly some areas, some sectors, countries that we find more favourable. And for a long time, we've been finding the consumer sector and consumer-orientated companies to be very attractive investments. In terms of direct consumer investments, many of these have become relatively expensive. This, of course, isn't a new story. Many people are also talking about the middle-class consumer growth, and in particular within Asia. So often we find an indirect play on the consumer market is an effective means of providing consumer-level growth in terms of return on equity, in terms of net profit margins, but at valuations much more reasonable for a bottom-up value manager such as ourselves. So one such example would be the financial sector, where you find many companies, particularly banks, that have very strong underlying consumer exposure. A middle-class consumer, some of the first services required are a bank account, a credit card. And so according to that, many companies such as those with micro-lending, with retail-orientated businesses have performed very strongly in recent years, and we think will continue to do so going forwards. In the larger cap space, in particular, we also find energy still to be relatively attractive, despite the very sharp correction that you've seen recently in the oil price. So our Asia Growth, which is our flagship large cap Asia portfolio, has a very notable overweight in the energy sector. Many clients have asked us whether this is something we're changing given the decline in energy prices, and the answer is an emphatic no. One of the key aspects we like about energy stocks in Asia is, first of all, they're very cheap, but second of all, there are some very long-term secular trends towards reform, towards market pricing, which we believe will improve the profitability of these companies going forwards.
What are some of the key risks that investors should be aware of?
Well, there are two key risks really from our perspective. First of all, as bottom-up investors, the primary risk that we're assessing and the primary focus of our risk management is corporate governance, assessing the quality of the companies that we're investing in, assessing the quality of the management, determining whether there have been in the past issues with corporate governance or, of course, fraud risk. So those are the sort of factors that we think are very, very important, particularly when you look at smaller companies within Asia and elsewhere in emerging markets. From a macro perspective, of course, emerging markets attract a lot of attention for supposed volatility, but it's important from our perspective to recognize that the past couple of crises in world markets, whether it's subprime, whether it's the euro crisis, these haven't originated in emerging markets, far from it. And so from that perspective, we certainly think it's important to consider macro risks But this is a key selling point of active management, addressing the fact that countries such as India, Indonesia, and others are performing well and are reformist, whereas others such as Russia and Brazil are perhaps on a slightly less favourable trend.
Emerging markets currencies have tumbled due to fears of a default in Greece and an escalating conflict in Ukraine. What is your take on this, and should investors be worried over this situation?
That's a very good question. Greece has been hogging the headlines now for years, on and off. And sometimes we find this focus on Greece and the supposed risks surrounding it to be a little bit exaggerated. So the total GDP of Greece is less than that of Beijing. Not less than China, but less than Beijing. There's 11 million people in Greece, and there's a lot more people than that in Beijing alone. And so really the stories that we're focused on are the growth stories elsewhere in the world. And in fact, the troubles that you're seeing in Europe and the Eurozone, if anything, that should be heightening investor interest in emerging markets, not causing them to flee emerging markets. There's only so much money that can be put in US treasuries, and we think from a growth perspective, from underlying bottom-up fundamentals, emerging markets, in particular within Asia, remain very attractive. The second issue of Ukraine addresses again the importance of active management. From the perspective of us looking at Russia, we find this a very interesting market, and one of the benefits of the Templeton Emerging Markets Group is that we have a very international team. We have 50 analysts across 18 offices. One of those offices is in Moscow. And so we have 3 analysts there, and they're regularly updating us on the situation in Russia and Ukraine. And one of the most interesting aspects, and one of the key reasons why we like to hire local analysts in these various markets, is the insight they provide us into the local mindset, the local thinking. And certainly when you hear the perspective of our Russian analysts, it is very different from the perspective that you are reading in your typical newspaper. And it certainly doesn't necessarily suggest that de-escalation is likely to occur, or that Putin is going to be able to force to back down. So we think negotiation is critical in this environment, and perhaps arming Ukraine is perhaps not the best way to de-escalate the situation. But critically, again, this is a European problem, a Russia problem as well, but a European problem. This is not something that impacts Asia. It's not something that impacts Latin America. And so the risk aversion associated with that, if anything, should be heightening again investor interest in parts of the world that are more stable, that are moving forwards on a positive path.